Hi there, I'm Sup Day. I'm a chartered accountant and an MBA. This is a follow-on from my earlier tutorial on accounting for equity investments and joint operations in group financial statements. The preparation of group consolidated statement of comprehensive income is often tested in final professional accountancy examinations. So the purpose of this tutorial is to discuss some of the main accounting adjustments required prior to the preparation of the group consolidated statement of comprehensive income. And after we've done that, we'll go on to prepare a full exam type question on a group consolidated statement of comprehensive income. Examination questions requiring the preparation of consolidated statement of comprehensive income provide individual financial statements of the parent and subsidiaries and accompanying notes detailing transactions between parent and subsidiary. It is useful to know that an entity is classified as a subsidiary where the parent company has a controlling interest, usually more than 50%, in the subsidiary's share capital. In such a scenario, both the parent and subsidiary's financial statements are combined and presented as one single entity. Prior to the preparation of the consolidated statement of comprehensive income, various adjustments have to be made to both parents and subsidiaries' income statements to eliminate group transactions. Accounting adjustments to the financial statements of both parent and subsidiary cover the following scenarios: eliminating all intergroup trading, making provisions for unrealized profit on unsold inventory at the group's financial year end due to intergroup trading, eliminating all intergroup loans and interest received and paid by companies in the group, eliminating all intercompany dividends paid and received by companies in the group, providing for any interest on any deferred liability obligation agreed on the acquisition of the subsidiary, and finally, calculating the minority interest share of the subsidiary group's after-tax profit. The first adjustment is to eliminate all intergroup trading in the group, and we do that by reducing the group sales and at the same time reducing the cost of sales by the amount of the intergroup trading. Adjustment number 2 is to provide for any unrealized profit on unsold group inventory as a result of intergroup trading. Now, unrealized profit in group inventory arises when one company in the group sells goods to another company in the group, and these goods have not all been sold externally at the end of the group's financial year end. So the accounting adjustment to make this provision is to increase the cost of sales by the amount of the provision, and at the same time reduce the group inventory by the amount of the provision. Let's look at an example of intergroup trading. Alpha, which is the parent company, supplies Beta, which is a subsidiary company, with the raw material which it uses in its production process. Alpha applies a markup of 1/3 to its cost. Sales of raw material by Alpha to Beta at the year end was 10 million. On 31st of March 2020, the inventories of Beta included goods costing 1 million, which had been purchased from Alpha. So what we are asked to show here, or to make, is the accounting adjustment to the group financial statements for the year ended 31st of March 2020. Now, the first adjustment is to eliminate the intergroup trading, and we do that by reducing the group sales by 10 million, which is the amount of intergroup trading, and at the same time we reduce the cost of sales, or the group cost of sales, by 10 million. The second adjustment is to provide for the provision for unrealized profit in group closing inventory. The first thing that we have to do is to calculate the markup on the goods sold by Alpha. And if you look at the question, we were told that on 31st of March 2020, the inventories of Beta include goods costing 1 million, which had been purchased from Alpha. So the amount of markup on that 1 million of goods which are still unsold at the year end and still in Beta's inventory will be 33% over 133, and that gives us the profit element of 0.248 million. Once we've done that, we can then prepare the accounting entries, which is to increase the cost of sales, the group cost of sales, by 0.248 million, and at the same time reduce the group inventory by 2.48 million. We'll now look at adjustments 3 and 4. Adjustment 3 is about eliminating all intercompany loans in the group and interest payment and interest received as a result of these loans. Adjustment 4 is eliminating all intercompany dividends paid and received by companies in the group. Here we have an example of adjustment 3 and 4. Alpha acquired Beta on 1st of April 2018 by acquiring 90% of Beta's share capital. On the same date, on 1st of April 2018, Alpha made a long-term loan of 25 million with interest of 8% to Beta. On 31st of December 2018, Beta paid a dividend of 5 million. This was the only dividend paid by Beta in the year ended 31st December 2018. Both Alpha and Beta have correctly accounted for the interest on the loan and dividends in their respective income statements. Required, show the accounting adjustments that are required prior to the preparation of group consolidated statements at 31st of December 2018. When preparing the group balance sheet, the 25 million, which appears as a non-current asset in Alpha's balance sheet and as a non-current liability in Beta's balance sheet, would offset each other and hence would be omitted from the group balance sheet. For the year ended 31st of December 2018, the interest payment on the 25 million loan is only for 9 months, which, according to the calculation, which is 8% times 25 million and proportionately 9/12 of the financial year, amounts to 1.5 million. This interest would appear as interest income in Alpha's profit and loss account and an interest expense in Beta's profit and loss account. When preparing group profit and loss account, the interest paid and received would cancel out. The dividend paid of 5 million will be shown as dividend paid in Beta's profit and loss account. However, only 90% of the dividend, which is 4.5 million, will be shown as dividend income in Alpha's income statement. The remaining 0.5 million goes to the minority shareholders who own 10% of the issued capital of Beta. Therefore, the 5.5 million dividend that Beta paid will be offset against the 4.5 million dividend income received by Alpha, and the remaining 0.5 million will be debited to the minority interest account in the group balance sheet. Adjustment 4 is providing in the consolidated profit and loss account for interest payable on the deferred liability obligation agreed by the parent company on the acquisition of the subsidiary. Let's look at an example regarding adjustment 4, provision for interest payable on deferred liability obligation agreed at the date of acquisition. The purchase consideration for a subsidiary company usually includes a deferred or contingent consideration payable based on the profit targets achieved by the subsidiary company in the years following the year of acquisition. A deferred liability account in the parent company is created on the date of acquisition and credited with the present value of the future deferred obligation payable. In the years following the date of acquisition, it becomes necessary to unwind the discount in the group financial statements each successive year until you arrive at the date of payment. The double entry to unwind the discount on the deferred liability obligation in the consolidated profit and loss account and balance sheet is to debit the profit and loss account, in particular the finance cost, and credit the deferred liability in the group balance sheet with the interest element, which is the time value of money, to build up the cost to the date of payment. Let's look at an example. Alpha agrees to pay £500,000 to Beta's former shareholders at the end of year 2 following the date of acquisition as part of the acquisition agreement. Assume an appropriate annual rate to use in any discount calculation is 10%. As we know the amount is going to be paid in year 2, the relevant discount factor for year 2 at 10% is 0.8264. Required, show the deferred consideration liability and interest costs in the group financial statements for year 1. Solution. At the date of acquisition, a deferred liability account will be created in Alpha's book and credited with the present value of £413,200. This is the £500,000 multiplied by the discount factor of 0.8264 to arrive at the present value of £413,200. At the end of year 1, the deferred liability account will be increased to £454,520, which is the £413,200, which is the opening balance, plus the interest cost of £41,320, which is 10% times 413 times 200. And this is also known as unwinding the discount. The consolidated profit and loss account in year 1 will therefore show an interest cost of £41,320 in respect of the deferred liability. In the following slides, we will attempt an examination question set on the preparation of a consolidated profit and loss account. Here you are given the financial statements of Alpha, which is a parent company, and Beta, which is a subsidiary, which has to be consolidated for the year ended 31st of March 2020. You're also given additional information, which is stated in the notes, regarding some of the items in the profit and loss account which require adjustments. You can pause the play button here and read through the notes before going on to the next slide. Again, additional notes. You can pause the play button and go through the notes. Here's the suggested approach in answering questions on the preparation of a consolidated income statements. Go through the additional information attached to the question and make the necessary adjustments to the balances that appear in the parent and subsidiary's income statement. Show all the workings of these adjusted balances, and when you've done that, you can go on to prepare the consolidated income statement. Note 1 1 has provided information on the acquisition price payable by Alpha for the acquisition of Beta on 1st of April 2018. The acquisition price has two elements, a payment now of 60 million and a deferred consideration of 26.62 million payable on 31st of March 2021. As we are asked to prepare the financial or consolidated income statement for 31st of March 2020, what is relevant here is the deferred consideration of 26.62 million. On 1st of April, the deferred obligation of 26.62 million would have a present value of 20 million. This is multiplying the 26.62 million with the discount factor in year 3, in 3 years' time, of 0.7513. This amount plus the 1-year interest at 10% gives us 22 million. And this should be shown as a deferred liability in the financial statements for the year ended 31st of March 2019. We are told that Alpha has correctly accounted for the deferred interest payable in its financial statements for the year ended 31st of March 2019, but not 31st of March 2020. So the amount to be provided for in 31st of March 2020 is start off at 1st of April 2018, showing the present value of the deferred consideration as 20 million. We add in the interest at 10% for 31st of March 2019, which is 2 million. And this gives us the opening balance on 1st of April 2019 of 22 million. For the year ended 31st of March 2020, the interest at 10% amounts to 2.2 million, and the balance on the deferred obligation account will be 24.2 million. We'll now look at notes 2 and 3. Note 2 deals with intergroup loans of 25 million on which the annual interest is 8%. As we are required to prepare the consolidated income statement only, we eliminate the interest payable and received, which amounts to 2 million. Note 3 deals with dividend paid by the subsidiary, which also has to be eliminated. So let's see our workings for notes 2 and 3 are as follows. Well, the finance cost, we start with Alpha taken from the information provided, which is 4 million. We add Beta's finance cost, also given to us in the question, of 2.5 million. If we go back and look at the accrued interest on deferred liability, which is in workings 1, which is 2.2 million. And finally, we cancel the interest on intercompany loan at 8% paid by Beta to Alpha of 2 million, and that gives us a total of 6.7 million for finance costs. Working 3, investment income from Alpha take given, which is 7 million. We deduct the interest received from Beta on the loan that Alpha made to Beta of 25 million, which is 2 million. And note 3, we cancel out the dividend paid by Beta and received by Alpha, which is 90% of 5 million, because that is the shares in Beta held by Alpha, minus 4.5 million. Look at adjustment 4. Alpha has a portfolio of equity investments which are correctly classified as fair value through profit and loss. However, the carrying amount of the portfolio has not yet been adjusted to its fair value at 31st of March 2020. On 31st of March 2020, the carrying amount of the portfolio was 32 million and its fair value was 33.5 million. So we have to increase the portfolio valuation by 1.5 million. Where this adjustment would take place is on the investment account or income of Alpha, which we've done some workings on. Working 3, we had an original figure of 7 million. We reduced it by the interest received from Beta of 2 million and also the dividend paid by Beta by 4.5 million. And we add in the increase in fair value of the investments of 1.5 million, and that gives us a total that will go to the consolidated income statement for investment income at 2 million. Adjustment number 5 relates to intergroup trading. Alpha supplied Beta with raw materials which it uses in its production process. Alpha applies a markup of 1/3 to its cost. Sales of the raw material by Alpha to Beta in the year ended 31st of March 2020 was 10 million. So what we've got to do here is to reduce the group revenue by 10 million and the cost of sales by 10 million. So Alpha's figure for revenue is given as 64.8 million. Beta's revenue is given as 39 million. We take away the intercompany sales of 10 million, and that gives us an adjusted figure for revenue of 93.8 million. We come to the cost of sales, again for Alpha, given as 26 million, Beta as 16 million. We take away the intercompany sales of 10 million. We've got a final adjustment on note number 5, and on 31st of March 2020, the inventories of Beta included goods costing 2 and 3 million respectively, which had been purchased from Alpha. So there has been an increase in inventory of 1 million, and we have to make the provision for unrealized profit by taking away the markup of 1/3 from the cost. So the way we do it is, again, take the 1 million increase multiplied by the profit element, which is 0.33 divided by 1.33, and this gives us a figure of 248,000 because we're asked to round up the figures. And that gives us a total adjusted figure for the cost of sales of 32.248 million. Right, as we have now completed the working, we're in a position now to prepare the group income statement. The first item on the group income statement is revenue, and we look to workings 4, and that shows us an adjusted figure of 93.8 million. The cost of sales is also worked out in working 5, and that shows an adjusted figure of 32.248 million. The gross profit is the difference, which is 61.552 million. The distribution cost, there has been no adjustments to that figure, so all we do is to add those two figures up to give us 7 million. The admin cost, again no adjustment, is 12.5 million. The finance cost, we look to working 2 to give us a figure of 6.7 million. Investment income, we look at working 3, and the adjustment figure is 2 million. And that gives us a profit before tax of 98.904 million. The income tax, again, is not adjusted, gives us a deduction of 11 million. So the profit for the year is 87.904 million. The other is the other items in the other comprehensive income, and this relates to the gain on property revaluations, for which there are no adjustments, and that gives us a total of 8 million and gives us a total comprehensive income for the year of 95.904 million. Now, in working out the profit for the year attributable to, we have recognized that we have got a minority interest, and that minority interest is 10%. And all we do is to take Beta's profit for the year, which is 11 million, take 10% of that, and that gives us 1.1 million. The balancing figure from the 87,904, which is the profit for the year, belongs to the group, which is 86.804 million. We then have to work out the total comprehensive income for the year, what belongs to the minority interest and what belongs to the group. We work out the minority interest, which is the 1100 or 1.1 million plus the 10% of 3 million to give us an overall figure of 1.4 million. And all we do then is to take away this figure from the total comprehensive income for the year, which is 95.904 million, and that gives us the group balancing figure of 94.504 million.